Ever heard of stock dividends but not quite sure how they work? In this quick guide, we'll unpack what they are, why companies use them, and how they affect your portfolio. Whether you're a newbie or an experienced investor, understanding stock dividends is key to building wealth.
Stick around for simple explanations and real examples that'll make everything click. What are stock dividends? Stock dividends are when a company gives you more shares instead of cash. Imagine owning 100 shares and getting 5 extra for free. This is a 5% stock dividend. You don't get money in hand, but your ownership increases. The share price drops slightly, so the total value stays about the same. No tax is owed immediately, which investors like. These dividends show confidence in the company's growth, as they often happen when businesses prefer reinvesting profits over paying cash. Instead of taking money out of the business, companies spread ownership further. Over time, this can help investors grow their holdings. Stock dividends are common with growth-focused companies and are a smart way to build long-term wealth through compounding. Why do companies issue stock dividends? Companies use stock dividends for smart reasons. They get to reward investors without losing cash, especially helpful when saving for projects or during uncertain times. Stock dividends also signal to the market that the company is confident about the future. Investors notice that. Plus, when more shares hit the market, prices drop a bit, making them more affordable to new buyers. This boosts trading and interest. Companies aiming for long-term growth often use stock dividends instead of cash, showing they're focused on reinvestment. It's a move that can attract both current and future investors. By offering stock instead of cash, firms strengthen their balance sheet while keeping shareholders happy. It's a win-win that reflects financial stability, strategic thinking, and growth. How do stock dividends affect share prices? Stock dividends increase the number of shares, so each one becomes a bit cheaper. Let's say you own 10 shares at $100 each. Your investment is worth $1,000. A 10% stock dividend gives you one more share, but now each share is worth around $91. Still, the total value remains $1,000. This price drop, called dilution, is normal and doesn't hurt your investment. Over time, if the company grows, the price can go back up or even rise higher. Many investors see this temporary dip as a buying opportunity. It's important to remember that even though the price per share falls, your ownership increases. Understanding how prices adjust helps you better track returns and make smart investment decisions. Are stock dividends taxed? Generally, stock dividends aren't taxed right away, unlike cash dividends, which get taxed the year you receive them. This makes stock dividends a favorite for investors thinking long-term. You only pay taxes when you eventually sell those extra shares, and even then, it's usually at capital gains rates. But there's a catch. If you're given the option between stock or cash, and you choose stock, you might get taxed immediately. Also, when you sell, the IRS looks at the average cost of all your shares to calculate gains. Knowing how these taxes work helps avoid surprises. While stock dividends can delay taxes, always check IRS rules or speak to a tax pro. That way, your strategy stays tax smart. Difference between stock and cash dividends. Cash and stock dividends both reward investors, but they do it differently. Cash dividends give you money right away. Great, if you need income for bills or spending. Stock dividends give you more shares instead of money, which helps grow your investment over time. Cash is taxed the year you get it. Stock usually isn't taxed until you sell. Also, cash payouts reduce a company's cash reserves, while stock dividends don't touch cash. They just shift ownership around. Growth-focused investors often prefer stock dividends since they compound returns. Meanwhile, income investors like retirees might favor steady cash. Choosing between them depends on your financial goals. Understanding the differences helps you pick the right strategy for your personal investing plan. How do stock dividends impact earnings per share? Earnings per share, EPS, tells you how much profit a company makes per share. When stock dividends are issued, the number of shares goes up, but the total earnings stay the same, so the EPS drops. For example, a company making $10 million with 1 million shares has an EPS of $10. After a 10% stock dividend, there are now 1.1 million shares, so EPS drops to about $9.09. This doesn't mean profits are down, it just means the earnings are split among more shares. Investors need to understand this to avoid panic. If the business keeps growing, EPS can rise again. Knowing how stock dividends affect EPS helps you see the bigger picture and make smarter investment choices. Small versus large stock dividends. Stock dividends come in two sizes, small and large. Small stock dividends are under 25% of the existing shares and are recorded at market value. So, if a company with 1 million shares gives a 10% dividend, it adds 100,000 new shares. In accounting, this value moves from retained earnings to paid-in capital using the market price. Large dividends, over 25%, are recorded at par value, which is often much lower than market price. A 30% dividend on 1 million shares adds 300,000 shares, and accounting rules treat this differently. The effect on investors is similar. More shares, lower price per share. But the financial reporting changes. Understanding these two types helps you read company reports and plan your portfolio better. Do stock dividends benefit investors? Yes, stock dividends have several perks for investors. First, they let you build up more shares without spending extra money. Great for long-term growth. Second, they're usually not taxed right away, which keeps your tax bill lower in the short term. Third, when a company gives stock dividends, it often signals strong financial health, which builds investor confidence. You'll own a bigger slice of the company, which could mean bigger gains if the stock rises. While the price per share drops, your total investment value stays the same initially. Over time, reinvested dividends can really add up. It's like compounding in action. For investors with a long-term mindset, stock dividends can quietly boost your wealth with little effort. How to calculate a stock dividend. It's easy to calculate a stock dividend. First, check the dividend percentage. Let's say it's 5%. If you own 200 shares, multiply that by 5%. You'll get 10 extra shares. Now you own 210 shares. The price per share will drop slightly to reflect the new total, but your investment value stays the same. For example, if shares were $50, they might drop to around 47.62 cents. This makes sense because the company is spreading the same value across more shares. You can also calculate your new average cost per share for tax purposes. Most brokerages do this automatically, but it's good to know how. Doing the math helps you track performance, spot value opportunities, and understand the effect on your portfolio. Common misconceptions about stock dividends. Many people think stock dividends are like free money, but that's not quite true. You get more shares, sure, but each one is worth a bit less, so your total value stays about the same at first. Some also think stock dividends are always better than cash. That depends on your needs. Do you want income now or growth later? Another myth is that stock dividends mean the company is in trouble. Actually, strong companies often use them to save cash and grow. There's also confusion about taxes. Yes, stock dividends usually delay taxes, but you'll still pay when you sell. Understanding these myths helps avoid mistakes and gives you a clearer picture when evaluating dividend-paying stocks. Now that you've got a clear picture of how stock dividends work, you're ready to make smarter investing decisions. Whether you're growing a portfolio or analyzing companies, this knowledge gives you a strong advantage. If this video helped you understand the world of stock dividends, give it a thumbs up, subscribe, and share your thoughts in the comments. Thanks for watching, and here's to smarter, more strategic investing.